So welcome to the 2023 Spring Meetings Governors Talk. My name is Alfred Kammer. I'm the Director of the European Department. And I have here with me Andrew Bailey, the Governor of the Bank of England, to discuss the issue of price stability and financial stability in an uncertain world. That was planned for a year, and we just hit it right in terms of the timing to make this a hot issue. Andrew has been at the forefront of the UK financial sector for over 3 decades. He has extensive experience and knowledge, and he is a leading authority on issues related to monetary policy and financial stability. Before assuming his current role as Governor of the Bank of England in 2020, Andrew had served as the CEO of both the Prudential Regulatory Authority and of the Financial Conduct Authority. So today, Andrew will share with us his insights on the complex interplay between price stability and financial stability, and offer his perspective on how the Bank of England is navigating these issues in the current complex economic conjuncture. And of course, that will allow us to draw lessons for all the other countries and experiences we have out there. So without further ado, I think I start us off with the first question, Andrew. Central banks have seen both challenges to price and financial stability over the last few months. How do you see the interaction between price stability and financial stability and central banks' ability to manage both?
Well, thank you, Alfred. It's a pleasure to be here. I mean, it's a vital question. And of course, in many ways, it's really testing the institutional structures that we've built up, particularly since the global financial crisis. So in our case, having both a monetary policy structure, a macroprudential structure, and a microprudential structure. And you always say it's how the pieces fit together at times like this that matter. So for me, the guiding principle is that, I'll start with monetary policy, that when we take decisions on monetary policy, of course, we always, whatever the conditions in the world at large are, we always take financial conditions into account in setting monetary policy, because obviously it's one of the influences of those decisions. And that's natural. It depends, it doesn't matter whether it's a good time or a less good time. What we shouldn't be doing is saying we've got such a problem with financial stability that we have to, in a sense, aim off a decision on monetary policy which is taken with, obviously, with our inflation target in primary view, because of conditions in financial stability. I think to go that step further, it's one thing to say we always take financial conditions into account, but it's another step to say, and in those situations of stress, let's say, we have to aim off monetary policy because we're concerned about the stability of the financial system. Now, 2 things, I'll finish on that. We have not had to do that in this situation. That's never been an issue, and that's important for me. The second thing I would say is that there's an intermediary step as well, which is that we have tools of macroprudential policy, which we can use to address financial stability concerns, credit concerns. So an obvious one is that if we felt it was appropriate, we would lower the countercyclical capital buffer as a first step. So that's, again, a set of particular tools that we've developed for financial stability, which are there to address those issues, rather than having to say, let's go straight to interest rates and do something different with interest rates. And I think that's very important.
So very clear distinction between monetary policy aims and financial stability aims, and we have different set of tools, and we have different institutional setup in order to deal with these objectives.
But that's correct. But I think we always have to be very focused on how do the pieces fit together. So how do we sort of bring these various pieces of policy making into alignment so that they work together?
Let me move to another topic. What are the early lessons from the Bank of England's quantitative tightening implementation, and how do you see the interaction between the policy rate hikes and the BOE's balance sheet reduction? What is your envisioned endpoint for the BOE's balance sheet, and how do you see this in comparison with the Fed and the ECB?
Well, start with two big points on this, I think. First of all, we've been very clear that we do not regard quantitative tightening as our active monetary policy tool. What I mean by that, and it sort of comes back to what I was saying a few minutes ago, is it's operating in the background. We've been very clear that we will use it continuously, but since we think that the effects of quantitative easing were state contingent, if we got into stressed market conditions, it is an option for us to suspend quantitative tightening. And by the way, of course, last October, we actually delayed the start of it because we felt we were in those sorts of conditions. So we want it to operate in the background, not as the primary tool. And then, as I was saying a few moments ago, obviously any impact it has on credit conditions, on financial conditions, will come through naturally through financial conditions, through market prices and so on, and we'll take it into account through that channel as we always would. That's the first thing. The second thing I think is a really interesting question is, of course, as you rightly said, where's it all going to in that sense? Now, I think there's an important point to make here. Monetary policy in respect of quantitative easing operated both through the interest rate channel and the asset channel. But monetary policy also operates, of course, on the liability side of the central bank balance sheet because we effectively transmit it at the start of the transmission mechanism through the rate we pay on reserves held in reserve accounts at the Bank of England. But those reserve accounts are also critical for financial stability because the liquidity buffers that banks now hold, they are an important element of the stock of high-quality liquidity. So if you take the major UK banks at the moment, there's about £1.5 trillion of liquidity coverage ratio high-quality assets, of which currently somewhere, I think, between 800 and 900 billion is reserves and cash. Now, two things I'll say about that. One thing, the reserve levels from a financial stability point of view were far too low prior to the financial crisis. I mean, we had reserve levels that were down in the sort of, I think, if I remember right, about 30 billion or something at one point. And of course, what that meant was that the financial crisis was, I think, made more difficult because the banks did not have adequate liquidity buffers, an important part of which is reserve accounts. Now, I give that a bit of history because I think that when we consider today what the steady state level of reserves is in the system, it's much higher than it was pre-crisis. So we're not going back to the pre-crisis position. Another way of saying that is part of the QE that we have done, actually we would have had to expand the central bank balance sheet anyway because of this need to increase reserves for financial stability reasons. Now, you can rightly say to me, so where's the target then? And the answer is, well, we don't know actually where it's going to settle at because that depends upon what you might call the equilibrium level of reserves. All I would say is I think it's going to be substantially higher than it was pre-crisis and it's going to be clearly lower than it is today. But where it is, and of course it can vary over time as well, it's not a fixed number. Now, the final element of the piece is, and what would be the composition of your assets on the central bank balance sheet in that steady state world? Because it doesn't have to be the same as it is today. I would imagine that we would have a larger stock of repo assets that we would turn over at higher frequency, and then probably some stock of steady state assets that we would also have. So, we're heading in that direction. But a key point to make is that the quantitative tightening process is going to bring the Bank of England's balance sheet down. It will bring it down to whatever that equilibrium level is. We may well take it on beyond that to give the headroom for a stock of repo assets. But it's not going down to where it was, in my view, it's not going down to where it was pre-crisis. And we're obviously going to have to watch very carefully for when we hit that resistance point. And that's, by the way, why when we started quantitative tightening, we also reintroduced a standing repo facility. It's not being used at the moment, but at any moment on any day, if we hit that resistance point, we'd be ready to sort of wheel it out and ensure that the short-term market rate was obviously consistent with the monetary policy rate.
So rolling off in the background, not a primary policy tool. To some extent, learning by doing, because that's something we haven't really done before. And we don't know what the impact is on the functioning of the financial market and monetary transmission.
Well, on that point, I mean, we watch it very carefully because we do not want it to have a detrimental effect on functioning of markets and a functioning of monetary transmission. Now, our markets team watch this every day, and they report to me every day pretty much on where we are. What we're not seeing a movement in any of the indicators we look at for the functioning of markets, so liquidity of markets, bid-ask spreads, all these things. We're not seeing anything that sort of stands out in that respect.
Good. Turning to financial stability. We have seen some bank resolutions in the past few weeks. What does this tell us about the resilience of the banking sector more broadly? What are your initial thoughts on how the post-2008 reforms, including resolution frameworks, have performed? Do you have any reflections on the implications and lessons learned from these events for the UK or more broadly?
Well, let me say, first of all, I think what we've seen in the last few weeks, as you say, is pockets of issues coming up in parts of the banking sector. I believe, and I've said a number of times, said again this morning, I do not see the evidence that we've got on our hands what I would call sort of the makings of a 2007-8 financial crisis. I really don't see that, actually. I think the system is in a much more robust condition, and we have got that's the first point of defense, but the second point of defense is that we've got a lot more tools in our armory to deal with these things than we had in 2007 and 8 when we were sort of somewhat making it up as we hit the crises, as it were. So we're in a very different place, and I don't see, I really don't see this as the sort of the beginnings of a systemic financial crisis in that sense. But you're right, of course, that there are learning points, lessons learned from all of these issues that we run into. And we will have to, both domestically and globally, and particularly globally in the Financial Stability Board, spend a lot of time thinking these things through. And I think if I had to pick some out so far of things that I've observed, I'll pick three things out. One is this what I call speed of run, which we saw particularly, I think, with Silicon Valley Bank. And there's two parts to that in a way. One is the sort of the changes in communication technology. Second one is obviously the ease of access to bank accounts to move them and withdraw them. But you can take it a bit, you can take it beyond that concentrated deposit base, and I think the question about the proportion of uninsured deposits in a bank. The higher that number, you can say, the more vulnerable that bank is to a run that can have serious implications. I think the second one is a very old-fashioned issue. I've been throughout various times in my career involved in prudential policy, since the late 1980s, and I think this is going to be the third time we're going around interest rate risk in the banking book as an issue. It's not in Pillar 1 of Basel. I say that with a slight pain on my face because we've had several goes on this issue. It's in Pillar 2. We in the UK, we do, there's two parts to this. Obviously, there's the accounting treatment and there's the capital treatment. Accounting treatments differ. Certainly for our banks, they really are more restricted in what they can hold in their hold to maturity book as opposed to fair valuing, which means they have to take the losses that are taken through into P&L, into capital. And we also we fully implemented interest rate risk in the banking book. So we're going to have to go around that issue again. And in many ways, this is a very basic piece of banking. You don't need lots of new tech to get to interest rate risk in the banking book. It's obviously fundamental to what banks do. So that's the second one. The third one is resolution. So again, I've been heavily involved in resolution for a long time. I did my first resolution nearly 30 years ago. I think I do push back on suggestions that the resolution framework we've got for large banks doesn't work. I think it does work, actually. The question is, do we use it? There is also, and let me say, because I really don't criticize, on this, because I know how difficult it is to do these things. The resolution framework is a playbook, to use a sort of sporting analogy for a moment, and you can choose how to use that playbook, and I think we must give authorities the credit to allow them to choose how to use that playbook. And there is a degree of art involved in that. It's both a sort of science and an art in that sense. But I think there are questions we're going to have to come back to, because if people feel they can't use the resolution playbook, then we've got to come back and ask the really fundamental question we've just spent 10 years or more developing this thing. Is it the right thing? I think it is, actually. But I think that, another issue we've then got is the question of, for smaller banks, where they're not issuing eligible liabilities because they don't issue in the market. So they're not increasing their sort of, their wedge of loss-bearing of liabilities. How the deposits protection limits work, and this comes back to the uninsured deposit points. And frankly, I think you have to ask the hard question. I mean, are uninsured deposits going to bear losses or not? And if they're not, and I'm not presuming that, but I mean, this issue comes up, then you have to think very hard, well, how do you resolve the bank?
Mm-hmm. You mentioned the speed of deposit withdrawals using current technology, but it was also the speed of market contagion translating these problems to Europe. For a standard banking type problem which you have during normalization, so Europe was equalized to the situation in the US. Any thoughts on how one could deal with this kind of market contagion and avoid it?
I mean, there are some issues around market structure. The CDS market is an extremely, illiquid market. And I think, if you ask many people, I think, in the business and said to them, do you think CDS really reflects the sort of underlying sort of true sense of risk? I think they'd be quite skeptical. But I think there's another important part to that, and so where we come in as authorities, and I think it's to do with communication. I mean, I do think that there are times when we have to communicate our view on the system. And I'll say two things on this. Well, first thing is, and I think we have to do what I call fact-based reassurance. I think you just coming out and saying, don't worry, it's all fine. There's a few journalists laughing in the audience at this point. It doesn't go down terribly well for good reasons. I'm sort of pretty much in the same place. So I think you have to do what I call fact-based. You have to say, look, here's the here's the facts. Here's the facts as we see them, the key facts of the system as we see it. And then the second point is, and this is the sort of, where you've got to sort of turn the mirror back on yourself. If when you say, well, I'm going to set these facts out, and if when you say, well, here the facts are, this is what I'm going to say, and it's all right. If you get to that point and you say, well, that doesn't look so good, does it? Then you know that you've actually, just communication isn't going to do it. You're going to have to do something. That's a really hard wake-up call at that point, I think. So you're going to have to take some action. So I do think, how we do communication, what we communicate, so fact-based communication, and what lessons and messages we take from those facts is very important.
While the stress has been in the banking sector, a significant focus of financial stability analysis and international policy work has been on non-bank financial intermediaries.
Yeah.
What do you see as key linkages between banks and non-banks in the present conjuncture? And what are the common themes in your view between recent banking sector stresses and previous stress episodes involving non-bank financial intermediaries, including the LDI crisis, which you had to manage?
Well, I think first of all, one of the things I would say, having had some these experiences with banks in the last few weeks, I think it's vital that we don't let our agenda on non-banks become sidelined or in some sense relegated by virtue of some issues coming up in the banking world, because the agenda on non-banks is crucial. I chair the Supervision Regulation Committee of the Global Financial Stability Board, and our agenda is absolutely full with the non-bank world. We're going to find some time to do some other things, but and we've got to keep on doing that. So all the work on money market funds, on open-ended funds, on crypto, on stable coins, all of this stuff has to go on. And I think what we've seen, I mean, first of all, I would say that the challenge with the non-bank world is what I call the breadth and the depth challenge. Mm-hmm. It's a huge landscape. It's got bigger post-financial crisis. I don't think that's particularly surprising in terms of the relative terms, because one of the consequences of regulating the banks more post-financial crisis has probably been to sort of change the balance of intermediation. It's actually also pretty heterogeneous. It's not it's not the non-bank world, that is. It's not a homogeneous landscape. It's that's the breadth part to it. The depth part to it is that what we've learned is that, some of these problems can blow up in fairly small pockets of that world, but they have the ability to spread in ways that, we didn't necessarily initially predict. And one of the points I would pick out there, I think it's one of the features of, if we look at some of the bigger non-bank experiences we've had in the last 3 or 4 years, so both the Dash for Cash in March 2020, the Archegos incident, the LDI incident, the nickel metal market incidents. One of the things I would pick out with all of those is that you had institutions, quite large institutions, that were at the sort of center of part of that, each one of those stories, who really should have only been able to understand their risk if they could see the whole picture. They could see their part of the picture and thought their part of the picture looked reasonably normal. What they didn't see was that there was a whole big other part of the picture out there. So whether it was because in the metal case, you'd got an on-exchange position and you didn't see the OTC market out there. In Archegos, you'd got part of it and you didn't seem to see that there were a load of other people with other quite big parts of it, and that these things were going to all come together. So that's another part of the story, I think, that unless you can, unless to risk manage those situations, you have to be able to see more than actually was being seen at that time. So I think that's another part that we have to be able to address. Final points I'd make about the non-bank world, and this is where the question of how central banks come into the picture, because I think one of the things we've learned from this is that we have to have a central bank toolkit that can deal with these problems. I mean, we used to say we're only in the bank world. I think we have to have reserve tools, as it were, to deal with extreme cases in the non-bank world. Now, I think you get a couple of things thrown up by that. One is in central banks is we don't regulate many non-banks, so we always sort of feel, well, how do we feel having as counterparties to our own operations people we don't regulate? So that's the first point. I think the second point is that, of course, for many parts of the non-bank world, it's an agency model, not a principal. The banks it's a principal model of business. It's on their balance sheet. They've got assets that they can pledge to us. One of the things we found in the LDI issue was that, of course, in an agency world, they didn't actually own the assets. So one of the reasons we had to do a market-wide intervention was because trying to do a bilateral intervention with the particular counterparties didn't work because they didn't own the assets. It was an agency model.
How are efforts to address NBFI data gaps and boosting their resilience progressing, and including the BOE's planned exploratory scenario for NBFIs?
Well, starting in reverse, I mean, one of the big reasons for doing the exploratory survey is because one of the things that I've sort of pestered our staff on repeatedly is what I call the breadth and the depth issue, is how do we survey such a big landscape at the depth that we need to survey it to spot where these things are cropping up. And we've got to come up, and this is globally, it's not domestic, because you can't see the parts separately. We've got to come up with ways of doing that effectively. What I would say on how is it, really good question on how is it progressing in terms of the work. Well, some of it's further up the pipeline than other parts of it. The piece that has probably made most progress is further work on money market funds. But I will make this point, the FSB can do its work on global standards, but it has to be implemented. And at the moment, the implementation record is too patchy at the moment. So we've got to have consistent implementation in this landscape.
I think we have 5 minutes for questions from the audience. Are there any? Yes, please. I think we need a microphone here. Maybe you start us off and then...
We'll come to you.
Yeah. Thanks very much. Can you hear me? Thanks very much for the very nice presentation. I guess one word that we didn't address is the uncertainty.
Yeah.
And so the natural question is, how does this first best option of clear separation between the aims, objectives, and the tools between price and financial stability changes in uncertain times? Right now, the big question is the financial dominance issue, because everybody's questioning whether the monetary policy will be ready to act, and as you said, not to aim off, because of the financial stability reason. So the question is, do you think monetary policy should act more forcefully during uncertainty, or actually be more careful during the uncertain times?
Well, I think you have to distinguish there, excuse me, uncertainty about the general economic conditions that we face, and therefore about the sort of the range of potential inflation outturns, and uncertainty about the financial system. I think, again, I would keep those two sort of distinct in terms of the tools we use, because I think that's appropriate. So in a way, we should address uncertainty in those worlds just the same as we address the sort of, in a sense, the sort of center of the distribution. So within in the monetary policy world, we spend a lot of time on uncertainty. We publish fan charts which attempt to convey some of the sense of uncertainty. And at the moment, I would just say, in terms of both the distribution of uncertainty and the distribution of risk, for instance, we've got the biggest upside, we've got the biggest skew on inflation, I think, either way, in the history of the MPC, which is now over 25 years. So the upside risk on inflation further out on the fan chart is the largest. And that, of course, then, that's the forecast. We then have to use that that's just one tool in our decision-making process. But how each of us thinks about conveying that, turning that uncertainty into a policy decision is obviously something we go through. On the financial stability side, I think it's crucial. I mean, it's a very good point you make. If we are highly uncertain about our assessment of the system, then we've got to take measures that, take that into account within the world of financial stability. I mean, it would certainly in the prudential world, macro and micro, if we were facing that situation, I would want to be more aggressive in terms of the financial stability measures that we take to reflect that. Sorry, I hope I'm not being drowned out by the noise.
No, I think we can hear you.
Yeah.
Inutu.
Thank you. I have one question. During COVID, there was a lot of forbearance by countries. So the credit risks, the quality of loans, we really don't know the quality of those loans because some of them were actually restructured. And now that interest rates are going up, they're not just affecting the banks, they're affecting the banks through duration risk, but they'll also affect the corporates. So we're going to have a double whammy in terms of credit risk as well as duration risk. So if we have that combination and we have the financial stability, can we really still separate, to the extent that monetary policy transmits through financial institutions? Will we not be in a position where we have to pay attention to financial stability to actually influence monetary policy?
Well, I think you make a very good point that, of course, the combination, or potentially the combination of the lending policies during COVID and the increase in interest rates could interact in quite a difficult way, potentially. Now, I think, first of all, I mean, we spend a lot of time focused on credit quality, both in household borrowing and corporate borrowing. The second, I can only speak for our own situation now, is that we have changed the accounting provisioning standards in the last few years so that we have now reintroduced a much larger element of expected loss provisioning. Do you want me to see? Hopefully do I push anything? That's on. We've introduced a much larger, it's reintroduced expected loss provisioning in a much more organized and sort of systematic way. And so the banks are now, one of the tools that they have and we have is what level of expected loss provisioning they should hold as part of their overall buffers against loan losses. And I think that's an important element to it. So it makes me more reassured that they've got those provisions in place ahead of losses crystallizing, because as you probably know, we used to be in a situation where provisioning had to sort of wait until losses crystallized, which in a sense is too late.
And last question over there.
Hi, Danai Kirkopulu, London School of Economics. You said that you don't see evidence that we're in the makings of another 2008, that this time is different and we have more tools in the armory. You also spoke about fact-based reassurance. Which facts, if they were true, would make you change your mind and be more worried?
Oh, well, I mean, I think first of all, I mean, looking at obviously looking at the sort of the building blocks. I mean, first of all, capital ratios, and how we expect those capital ratios to evolve under stress. I'll come back to stress testing in a moment. And then the same thing for obviously liquidity ratios, both the liquidity coverage ratio and the net stable funding ratio. They are both important elements. I mean, one thing I'd emphasize, because you sometimes hear different commentary on these things, that the post-financial crisis liquidity policy has two elements to it. And we shouldn't assume that one is sort of better than the other or one replaces the other. We need both of them, because the LCR is a more short-term, in a sense, measure, and the NSFR is a more medium-term. Come back to stress for a moment. I think it underlines the importance of stress testing. But let me say two things on that. First of all, it's important to use several scenarios in stress tests. We've always taken the view, I've always taken the view, we've always taken the view, there are basically two scenarios in bank stress tests for rates. One is what I call a rates up in a recession scenario. So this is where you're doing the thing that you don't want to do. You're having to put rates up heavily in a recession, and that's a stress test on banks. The second one is a low for very long scenario, where you're sort of pinned at the sort of the lower bound for sort of the duration, as it were, and both of those are important to do. We're currently running a stress test at the moment, which is a rates up scenario with a pretty negative stressed scenario in terms of the economic prospects, and you have to do both of those two things. I would, however, say, because this does get said sometimes, and applies both to the bank and the non-bank world, of course, you have to pick your stress point. I mean, I think it's important. So, it's like forecasting. We can pick stress tests based on sort of forecasts, and obviously they're forecasts for the tail of the distribution. Black swans can happen beyond that, and you have to have other tools, whether they're resolution tools or intervention tools of the sort we used in the LDI market, so to take care of those things that you don't have what I call this approach in history, where you sort of take history and add something on, but you're not claiming that you can foresee every possible event that could happen in the future, because none of us can, frankly.
Mm-hmm. Good. Thank you very much, Andrew, for all your insights. Thank you for all of you attending, and a big round of applause, please, for Andrew.